Here is a mathematical reality the finance industry would prefer you not dwell on. Over long periods, the majority of professional fund managers, smart people paid absolute fortunes, staring at screens all day, fail to beat a strategy so simple it fits in a single sentence. By the end of this video, you will know exactly what that sentence is, why it wins, and the one specific mistake that ruins it for most beginners. A quick ground rule before we start. This is an education in how the financial machine works, not personalized financial advice. I'm teaching you how to build the engine, not telling you what to buy. The first step is completely changing how you view the stock market. Most people treat investing like a casino, a game of predicting winners and hoping for a payout. To build actual wealth, you have to treat it like a highly predictable, engineered system driven by strict mathematical variables. Once you look at it as a machine, you realize something liberating. Successfully building wealth isn't a measure of your innate intelligence, and it doesn't require predictive talent. It is entirely a result of following the engineering rules. The foundational math of this entire system is compound interest. It means the money you deposit earns returns, and then those returns earn their own returns. Early on, it works like a snowball the size of your fist, but growth on growth eventually accelerates. This chart plots investment growth over 40 years. For the first decade or so, your own deposits are doing most of the heavy lifting. But give it enough time and the curve accelerates upward. By the final decades, growth exponentially takes over, and the vast majority of your final wealth pile is pure compounding, not original deposits, which produces a very counterintuitive math problem. If you invest a modest amount in your 20s and then stop entirely, you can mathematically end up ahead of someone who starts in their 30s and invests much heavier sums. The late starter can pump cash into the system aggressively, but their final total fails to catch up. They lack the runway. This reveals the most expensive trap in personal finance, the belief that you should wait to invest until you have more money. It feels like a responsible decision, but it quietly ruins the math. Skipping your earliest investing years means skipping the highest-powered compounding years you will ever own. Adding more cash later never fully buys those years back. Time inside the machine is the one variable that money cannot purchase. Starting isn't a financial milestone you wait for. It is a habit you install as early as possible. So how do you actually capture that compounding math? Here is the core flaw of picking individual stocks. To win, you have to be right about a single company's future more accurately than the institutional professionals on the other side of your trade, and we already know most of them can't even beat the market average. The solution is a vehicle designed to bypass the need for prediction, the broad market index fund. Instead of betting your money on one company, an index fund allows you to buy a piece of the entire market. Watch how this works. You buy a single fund, represented by this circle, but internally that fund fractures, giving you a tiny fractional slice of hundreds of different companies simultaneously. You own the entire board in a single purchase. Because of that internal diversification, the system survives without your intervention. Over the decades, some companies in that circle will fail entirely. But the explosive gains of the winning companies mathematically offset the losers. The outer boundary continues to grow, and you never had to guess who the winners would be. In this system, trying to find the needle in the haystack is a liability. Mathematically, it is infinitely superior to just buy the entire haystack. It is deliberately, gloriously boring. To feed this machine, you need a rule for your inputs. It's called dollar cost averaging. You invest the exact same amount on the exact same date every month, automatically. High market months, low market months, it averages out. Automating the input deletes the anxiety of trying to time the market. But a machine this powerful generates friction, and in investing, that friction comes from fees. Fund managers often charge an expense ratio to run their portfolios. A 1% annual fee sounds like a rounding error. It is not. Look at these two identical growth curves. They start the same, but the bottom curve is subjected to a 1% fee, charged on the entire balance every year for decades. That tiny fee acts as a wedge, slicing away a massive portion of your final wealth. Money that should have been compounding was intercepted by a manager. This is why you must aggressively seek out low-cost index funds. The fees on broad market index funds are often a tiny fraction of what managed funds charge. Finding that small number makes an enormous long-term difference. Optimizing this requires two rigid behaviors: relentless automation of your inputs and unforgiving vigilance against fee drag. If the math is so reliable, why do so many people fail at this? Because the market will drop. Not might, will. It is an absolute historical certainty that the market experiences sudden, brutal drops. When that happens, the untrained psychological instinct screams at you to panic, to sell your investments and protect whatever cash is left. This chart shows how the trap plays out. The beginner sees the plunge, panics, and sells at the bottom. They sit in cash until the market feels safe, meaning prices are high again. They sell low and buy high, locking in a permanent loss. Historically, diversified markets have recovered from every crash and moved higher. The people whose portfolios were permanently destroyed were overwhelmingly the ones who interrupted the compounding math by selling. The biggest risk to this wealth-building machine is not the global economy. It is you, at 2 in the morning, overriding the system with the sell button out of pure fear. The defense against that fear is a behavioral mechanism called pre-commitment. You decide right now, in calm waters, that drops are an expected part of the math. Automatic investing continues through the crashes, and nothing gets sold on a red day. Which brings us to the single sentence that defeats the Wall Street professionals. Buy broad, low-cost index funds automatically every month, keep fees tiny, and do not touch it for decades. That is the entire mechanical system. It requires no daily charts, no searching for hot tips, and no active trading. This strategy is the culmination of everything we've built in this series. Psychological defense plugged the leaks in your spending. Smart credit protected your borrowing. The automatic budget created the monthly surplus. And this machine is exactly where that surplus goes to grow. Building real wealth is ultimately a lifelong test of patience. It is the reward for doing quietly what cleverness mostly fails to do loudly.